Way back in 2009, I started my investing journey with a lump sum of £5,000. I then added spare money each month from my wages. I still have my trusty old laptop I bought 15 years ago for the sole purpose of buying shares and starting my investing journey. Things were very different back then. It cost me £12.50 per trade, and there was no such thing as commission-free apps like Free Trade or Trading 212. And the only pies I came across back then looked like this. Oh, very tasty. My Barclays platform at the time didn't allow me to buy overseas shares, and exchange-traded funds were not mainstream. I'd never even heard of them until several years later, so I grew accustomed to buying large-cap UK stocks. More recently, however, I've invested a significant amount into a range of ETFs from across the world. The laptop cost me £388 at the time, and I always wondered if one day this computer would pay for itself. Well, 15 years later, I'm pleased to say it's paid for itself 552 times. In this video, I'll go through my entire portfolio and reveal its performance over the first half of this year and since I started in 2009. I'll also reveal what I've been buying and selling and my plans for the coming months. This is not investment advice, and I'm simply showing you my own journey. I'll go through the sectors in ascending order of performance this year. In the chemical sector, I have only one company, Croda, and it's had a terrible year, down over 20%. It made huge profits during the pandemic as it supplied a lot of medical materials and equipment. But since then, revenue has collapsed. Could these low prices be a bargain, and will Croda experience a major bounce back at some point? Only time will tell. As I go through the slides, this figure shows the average price change for the year so far in the companies I have in a given sector. It's based on the companies I hold and not the industry as a whole. This figure shows the value of my current holding. This figure is the year-to-date price change, and because Croda is the only company I hold in the chemical sector, it will be the same as the figure at the top. And finally, here is the dividend yield. I have just over £7,000 invested in Croda, so I would currently expect to receive dividends of just under £200 a year. In the mining sector, I have only one company, Rio Tinto, and it's down 11.7% this year. The prices of copper, diamonds and industrial minerals have fallen in recent months, but the company has a strong balance sheet and should hopefully do well over the long term. But mining is a cyclical sector, and it sure can be a roller coaster ride at times. Rio Tinto pays a fairly high dividend of 6.6%. In the renewable energy sector, I now only have one company, Greencoat Wind Energy, having moved out of solar completely and gone all in on wind. I just feel that with the weather as it usually is in the UK, wind energy will be a lot more profitable than solar. Greencoat is down 11.5% this year, but it pays a big dividend of 7.8%. With plans for the UK to become a clean energy superpower by 2030, I believe that this company could do well, and I'm happy to hold for the long term. In the utility sector, I own three companies. Both National Grid and SSE are down this year, with National Grid having just completed a rights issue after they unexpectedly asked their shareholders for extra funds to pay for infrastructure upgrades and improvements. The third company is United Utilities, and it's having a bit of a rough time lately with sewage spills which will require expensive remedial action. Now for the house builders, and I've got back into Persimmon after having sold the shares more than 10 years ago. The shares are down slightly on the year, but Labour's plans to deliver 1.5 million homes over this Parliament could be good news for house builders such as Persimmon. Next is the consumer goods sector, and I have three companies. Very mixed fortunes for these two. Diageo is still struggling after a profits warning due to lower sales in Latin America. But Unilever has been on a bit of a bull run lately, up nearly 15% this year. The third company is Haleon, a consumer healthcare business, which was spun off from GSK a couple of years ago. It could well be a takeover target in years to come, so I'm happy to hold for now. In the food and tobacco sector, I have three companies. Both British American Tobacco and Imperial Brands have had a difficult few years, but now seem to be on the rise again, and the dividends are very large. However, the cigarette business is declining in multiple markets and there are also regulatory risks. The companies are working hard to diversify into non-combustible goods, but it's going to take time for this transition to bear fruit. Tate & Lyle's share price is down significantly this year, mainly due to announcing plans to buy out CP Kelco, which makes sustainable health-based ingredients. This could cost Tate & Lyle £1.5 billion. There are fears the dividend might have to be cut to fund this acquisition. In the retail sector, I have only one company, Tesco, and it's up 5.1% this year. The company has been growing its sales significantly over the last year, helped by lower inflation and stronger consumer confidence. In the brokerage services, I have two companies. Both IG Group and the London Stock Exchange have shown gains this year. IG Group has been growing its revenue and the business looks solid. The London Stock Exchange Group is one of the world's premier financial data companies and will soon be offering customers a range of artificial intelligence-powered solutions. In the oil and gas sector, I have two companies. BP is only marginally up. Its more aggressive transition into green energy is proving costly and affecting profits. Shell has done better as it's been scaling back on renewables and has a more renewed focus on oil and gas. Next, we have an exchange-traded fund. This one gives me exposure to the complete FTSE 100 and it's up 5.8%. It pays a decent dividend of 3.9%. Here are the main companies you would own. Ongoing charges for this ETF are very reasonable at 0.07%. In the pharmaceutical sector, I have two giants, AstraZeneca and GSK. AstraZeneca is up 14.5% this year and the outlook for the company is solid, with the board expecting total sales to increase significantly in 2024. The GSK share price has been under pressure recently because of US regulations on one of its vaccines and a heartburn medication having to be discontinued over safety concerns. But GSK is now a more efficient and streamlined business and should hopefully do well over the long term. Next is a couple of all-world ETFs which combined invest in thousands of different companies across the world. VWRL is relatively new to the portfolio and is more focused on share price growth. VHYL invests in companies which pay higher dividends. You might be asking why I've got both. Well, I keep VHYL inside the ISA to protect the dividend and VWRL outside the ISA. If you want my opinion on which I think is best to own for the long term, I'd say it's VWRL, as its growth in share price seems to more than outweigh the higher dividend of VHYL. VWRL is the one I plan to add more to going forward. If you find these portfolio updates useful and would like me to continue making them, then please give me some feedback by hitting that like button. In the insurance sector, I have just one company, Aviva, and it's up 10% this year. It also pays a hefty dividend of 7%. Many analysts still consider Aviva's share price to be fairly cheap, but I wouldn't expect huge growth. The UK's insurance market is highly competitive and Aviva faces many rivals. Fortunately, the high dividend yield gives the stock great value either way. Next is a big favourite of many investors. It's an S&P 500 ETF and gives you exposure to all those big American giants. The one I have is IUSA and it's up 15.8% this year. ETFs were not mainstream back in 2009 when I started, but I've been buying plenty of this ETF over recent years. It's another one I keep outside the ISA and the dividend yield is fairly low. We are now into the top 3 and in the banking sector I have 3 companies and they have all had a spectacular year so far, with Barclays leading the way with a share price rise of almost 35%. The new CEO is implementing a plan to turn the company around with a huge cost-cutting program, and with interest rates said to moderate towards the Goldilocks zone of around 2.5 to 3.5%, things are looking up for customers and banks alike. HSBC is also up this year and pays out a very impressive dividend of over 7%. The third bank I own is Lloyds, which also pays a decent dividend of 5%. The share price is up nearly 14% at the time of this video. On the subject of banks, the portfolio I've been showing today is kept with Barclays Smart Investor, but they are quite expensive however, and there are plenty of cheaper options out there such as Trading 212, who will even give you a free share worth up to £100 to help you get started. Just click on the link in the video description to start your journey today. The second highest performing sector for me this year is information technology. I have two companies and they are relatively new to the portfolio. Both are benefiting from the rise in AI, with a share price growth of nearly 20% this year. The dividends are fairly low, so these two are kept outside the ISA. There simply isn't room to keep everything inside. The new British ISA, if it arrives next year, will definitely help matters. And yet again, the top performing sector is aerospace. BAE Systems shares are up 32% this year, as countries from around the world continue to boost their defences. In the UK, there are plans to spend 2.5% of GDP on defence. Rolls-Royce is up an incredible 53% this year as we all return to the skies after the pandemic. It's still the largest holding in my portfolio despite me recently selling £10,000 worth of shares. The company does not pay a dividend currently, but I wouldn't be surprised if payments are restored in the next year or so, and that news could boost the share price further. Now for all my buys and sells this year. With the portfolio now paying over £1,300 a month in dividends, I don't always have to put new money in to buy more shares. A lot of money this year has gone into my new all-world ETF, VWRL. It's one of the most popular ETFs out there and I've become a big fan, investing around £8,000 into it. When you invest over many years, you may find that your strategy evolves over time, especially with constant changes in financial products, taxes, and the economic environment. I've invested just over £4,000 into my FTSE 100 tracking ETF. In terms of single companies, a large chunk of money has gone into Experian. When I fill my ISA, then I have to look for low dividend payers, which I can keep outside. Experian fits the bill nicely. I've put £3,000 into my S&P 500 ETF, which is another one I keep outside the ISA. And here are all my other purchases this year. Big sudden share price drops often entice me to load up, something which happened this year to National Grid when they announced an unexpected rights issue. In addition to the 2.1k shown here, I also purchased the rights issue in full, which brings the total invested into National Grid this year close to £5,000. Why not subscribe to be one of the first to know about any other purchases I make in the year ahead? And here are all the sales. I've trimmed Rolls-Royce to reduce risk and rebalance, as it was beginning to dominate the portfolio. History shows that those who occasionally rebalance their portfolios make an extra 5%, which might not seem dramatic, but 5% over the course of an investing lifetime is huge. Rolls-Royce has done extremely well, but because of a phenomenon known as reversion to the mean, there will be times in the future when it will not perform as well. It's still the largest holding in my portfolio. I also sold a slice of AstraZeneca to raise funds for the National Grid rights issue. I intend to buy back all the AstraZeneca shares before the end of the year. All my Bluefield Solar shares have gone, and so too are the Renewables Infrastructure Group, as they are quite big in solar power. All the proceeds from the solar shares have gone straight into Greencoat Wind Energy, which I now believe is the better bet. And now for my plans for the months ahead. I intend to invest a lot more into my ETFs, especially VWRL. I'll slowly buy back the AstraZeneca shares I sold. I'll keep a beady eye on Unilever and might add more as it's growing with some momentum. And a potential new company I'm looking at is 3i. It's up 160% over the last 5 years, with impressive dividend growth as well. Cash in the portfolio stands at £2,414. Now for the portfolio performance this year. At the end of 2023, the portfolio stood at 415k, and at the end of June 2024, the portfolio currently stands at just under 472k. £10,700 from my wages has gone in this year, giving me a net gain of 45k. That's 10.9% return over the last 6 months. I'll now compare the half-year performance of the portfolio with other indices, and to do this fairly, I'll strip out any dividends I've been paid this year so far. With dividend payments subtracted, the share price growth is 8.8% for the first half of 2024. You can see in this table the portfolio has outperformed the FTSE 100, 250 and all-share index, but it's performed less well against the S&P 500 and all-world indices. As you saw earlier, I've been adding a lot more of these ETFs and will continue to do so going forward. Now for my overall performance since I started in 2009. I made plenty of mistakes in the early days as I was learning the hard way, and all my figures include everything. The total amount I put in from my wages since I started is 257k, but I didn't put this in as one big lump sum. I only had 5k at the time. I simply drip-fed in spare money each month. If I had been able to put such a large sum in at the start, then my gains would have been much greater. And yes, I would have done better if I had invested in an index tracking ETF from day one. But they were not mainstream back then, and I was limited by my platform to buying individual UK companies. As you have seen, the value of the portfolio stands at just under 472k, giving me a current net gain of 214k or 83%. Many investors will have done much better than this, of course, and I'm only showing you my own journey. Not only is my capital growing, but the dividends I'm receiving per month are now large enough to cover all my essential bills. The companies I own are effectively paying all my bills for me. To see how you could do this too, then click this video here.